Look at this chart. Here the price was in an uptrend. Here we got a reversal and the price turned to a downtrend. Identifying a reversal like this in practice is very challenging because while the price was declining, it could be just a pullback and then further advancing of the price, exactly like what happened here or what happened here. But in this video, I want to introduce this indicator that can effectively help you to identify a reversal like this and write the new trend that is developing in the market. This indicator is built based on rate of change calculations, and then it is smoothed 2 times by the help of exponential moving averages. To have it on your chart here, you just need to click on indicators and search decision point price momentum oscillator, this one, which is written by Lazy Bear, and it is a popular indicator on TradingView platform. It is somehow similar to MACD, but as I explained earlier, it's a complete different calculations which is built based on rate of change. We have this oscillator line and this signal line here, and depending on their crossings, the area between them becomes green or red. When the oscillator line crosses below the signal line, it's a signal that the bearish momentum is increasing and the area becomes red. And when the oscillator line crosses above the signal line, it's a signal that upside momentum is increasing and the area becomes green, as you can see. Similar to MACD, this is reflected on this histogram, so you can also analyze the momentum changes here by the help of this histogram. By default, the color of the histogram is gray, which here in the settings of the indicator, here you can enable histogram color. Similar to MACD, when the oscillator line crosses below the signal line, we have the bars below the center line, and when the oscillator line crosses above the signal line, we have the bars above the center line. The bars are green when above the center line and they are red or orange when they are below the center line. When they are lighter green, it shows that upside momentum is increasing, and when it becomes dark green, it shows that upside momentum is decreasing. Similarly, when red, it shows that the downside momentum is increasing, and when it becomes orange, it shows that the downside momentum is decreasing. The same way that we interpret MACD and evaluate momentum changes, here also you can use this indicator in the same way. Alright, now let me teach you how you can use this indicator for identifying reversals. This indicator is very powerful for identifying divergences because it is built based on rate of change, so it can effectively help us to know when the change of the price movement and the change of the oscillator are not agreeing on the same direction. For example, here you can see that the price made higher high, but the oscillator made lower high. This is called bearish divergence, and it is a leading signal that probably a reversal is going to happen. When we have this situation, it tells us that the upside momentum is weakening, and on the other hand, the downside momentum is gaining strength. But this is just an early signal, and any trading decision regarding the reversal of this uptrend to a downtrend will definitely need more confirmation. We can use other indicators for more confirmation, but I recommend using price action analysis, which helps us to have not late signals. It's very easy and you just need to pay attention to my explanation. When the price made higher high and the oscillator made lower high, here between the two highs, here we have a sewing low. We mark the low of the sewing low and we wait for a candlestick to be closed below this low, because this level can act as a potential support level. And in this case, you can see how the price was reacting here near this level. When this level is broken and we get a candle closed below this level, the reversal is confirmed and we can enter a short position. Please pay attention that you should never take a trading decision only based on the divergence signal, because after a divergence, we can just have a pullback. For example, here you can see that the price made higher high, but the oscillator made same level. This is also a bearish divergence, although it is a little weaker signal, and you can see that the price didn't break the low of the pattern and we had further advancing of the price before having any possible reversal. Alright, now let me teach you a bullish divergence setup. Here, following this downtrend, you can see that the price made lower low, but at the same time the oscillator made higher low. This is called bullish bullish divergence, and it tells us that the downside momentum is weakening and the upside momentum is gaining strength, and this gives us the probability that the price may turn to an uptrend. But we need more confirmation for any trade entry. Between the two lows, here we have a sewing high. We mark the high and we enter a trade only if we get a candle closed above this high, which didn't happen. As you can see here, the price made same level but oscillator made higher low. This is also a bullish divergence, telling us that the upside momentum is gaining strength. Again, we mark the high of the pattern and we wait for a candle to be closed above this level, which you can see that it didn't happen, and the price is in a trading range here. Here the price made same level but the oscillator again made higher low. This shows that the bulls are really gaining strength and we have high probability to have an upside break out of this range market. We mark the high of the pattern, which is the sewing high between the two lows, and we wait for a candle to be closed above this level. Here you can see that the price made higher low, which is an early signal here that probably an uptrend is starting, and at this point the price is closed above this level and you can see how the price turned to an uptrend. When we have a divergence signal, it only tells us that the prior trend is weakening, and this weakness could be just because of a pullback, and many of the times the price goes to a trading range before having any possible reversal. So you should never take a trading decision only based on a divergence signal, and you need more confirmation that there is higher probability that a reversal is happening in the market. Catching reversals in the market is considered a high risk trading because you are entering a trade against the trend of the market. So in compared to a trend following strategy, in reversal strategies you have higher degree of risk, and because of this having a proper risk management strategy is extremely important so you can limit your losing trades and protect your account from falling significantly. There is a risk management strategy that is called 1% rule, and is one of the best risk management strategies that you can use. By the help of this risk management strategy, your position size is calculated in a way that in case if the market goes against you and hitting your stop loss, you will lose only 1% of your trading account. For example, if you have a $10,000 trading account, you will only lose $100, which is only 1% of your trading account. This risk management strategy helps you to minimize your losing trades as much as possible, and this will help you to effectively protect your trading account from falling significantly. I have a complete guide on this. The link is also placed in the description, and I highly recommend you to watch it because without a proper risk management strategy, you cannot become a consistently profitable trader. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.